Hello everyone, I am Julie Mauroy, your Sustainable Legal Coordinator. I am pleased to present ESG Summer 2025 ESG Derivatives, a video featuring Ambra Moschini, Head of Sustainable Finance Unit at AMAFI. We will walk you through 3 ways derivatives can support ESG goals, as well as the current regulatory challenges. This video follows the conference held in June, Is There a Sustainable Future for ESG? And is a part of our summer series, ESG Summer. Welcome, Ambra.
Hello everyone. Thanks for having me. So as Julie said, I'm currently leading the Sustainable Finance Unit at AMAFI. So a few words about AMAFI. It's the French trade association representing market participants of sell-side industry located in France. And at AMAFI, we work closely with regulators and the industry to ensure that financial markets operate within a sound and efficient regulatory framework that supports competitiveness, protects investors, and contributes to economic growth. So as Julie said, today I'd like to give you a short and simple introduction to ESG derivatives, a topic that can seem technical but is becoming more and more relevant in the financial world. So I tried to keep things clear and straightforward. An ESG derivative is just like any other derivative, such as a swap, option, or forward, but it also serves an ESG purpose. In other words, it's a financial tool that integrates environmental, social, or governance considerations. There are several ways this can happen, and I'll give you a few examples. So the first way, and the most important one, is to provide exposure to ESG assets. So the most direct way a derivative supports ESG goals is by providing exposure to an ESG-related assets such as a climate index or a basket or companies with high sustainability ratings. For example, investors may buy futures or options on a green index composed of firms reducing their carbon emissions, with expectations that these companies will perform well over time. A similar effect can be achieved when derivatives are embedded within financial products, such as structured notes, allowing investors to gain indirect exposure to sustainable assets through tailored investment strategies. This enables access to ESG assets without holding them physically, which can reduce transaction costs and increase flexibility. But let's be clear, derivatives are neutral tools. They work both ways. They can also be used to sell or short ESG assets, so they are not inherently green. What matters is how they're used. When used to gain exposure to ESG assets, derivatives can help increase demand, lower the cost of capital for sustainable companies, and support the transition towards greener business models. So the second way for a derivative to incorporate ESG goals is to make its payoff vary depending on whether these ESG goals are reached by the counterparty or not. These are called sustainability-linked derivatives, so that we will call ESLDs, and their spread can vary, or additional payments like penalties or bonuses may be triggered depending on the outcome of ESG targets. This mechanism provides an incentive for the counterparty to reach its sustainability goals, such as carbon emission reduction, energy efficiency improvements, circular economy targets, etc. So there are many. Let me give you a simple example about that. A company enters into an interest rate swap with a bank. If the company hits certain ESG targets previously agreed with the bank, like reducing Scope 1 and 2 greenhouse gases emission by 20% by 2026, it gets a better rate. If not, it pays more. This creates a financial incentive to meet sustainability commitments. SLDs are typically interest rate swaps or FX derivatives. But to be effective, these instruments must be carefully designed. The ESG targets should be ambitious and measurable, and the financial incentive must be meaningful. Key questions to consider, to build these kind of products. So, is the pricing structure truly beneficial? Is the bank genuinely offering better terms if the targets are met? How is compliance with ESG KPIs verified? Is there any third-party assurance? Or it is self-reported by the company? In short, these can be a helpful tool, but only if the ESG mechanism is strong enough. Some initiatives are now underway to improve market standards. For example, is the Sustainability-Linked Derivatives Clause Library, which provides standardized contractual languages and best practices for integrating ESG KPIs into derivatives contract. So the third way for a derivative to contribute to ESG objectives is by enabling an ESG investment strategy through risk management. So it's the classic role of derivatives, hedging. So is the most indirect way, let's say, but it's very important. They help manage ESG risk, so like climate transition risk, physical climate risk, and the risk related to ESG investment, so like interest rate or currency risk. For example, imagine a farmer whose harvest success depends heavily on rainfall. But because of climate change, there is a growing risk of drought. To protect against that, the farmer can buy a weather derivative. It is a simple financial contract that pays out money if rainfall drops below a certain level. If there is not enough rain, the farmer loses some of the harvest, but gets money from the derivative to help cover the losses, like insurance. If the rain is normal, the farmer doesn't need the payout, but still has a good harvest. Another example, this time on ESG strategies, is imagine an asset manager that builds a portfolio of green bonds from different countries. So in this case, they may face interest rate or currency risk, and they may choose to use an FX forward or an interest rate swap that allows them to hedge these risks and help make the investment strategy more viable on the long term. So these tools may not have an ESG objective per se, but they enable sustainable investment strategies to take place. This is where things get tricky. Today ESG derivatives are not fully captured by EU regulations, even those that provide clear exposure to sustainable assets. Why? But because they are seen as complex and because they can be used both positively and negatively, as we said. Current regulation tends to focus solely on physical holding, ignoring the exposure created via derivatives. As a result, ESG derivatives are only partially covered under SFDR, so the current version of SFDR. They are excluded from EU taxonomy frameworks. There is no clear guidance on how to measure the ESG contribution, and practices vary widely between member states. This creates a lot of uncertainty, especially for banks and asset managers. So AMAFI advocates for considering derivatives for what they bring, no more nor less. They should be assessed based on the exposure they provide. So if a derivative increases ESG exposure, it should be recognized. If it reduces it, that should be reflected too. The key is to focus on derivatives on equities and corporate bonds, and to account for the exposure they provide or withhold. In other words, their net ESG contribution. This approach already exists in some other jurisdictions, like in the United States. Hopefully, we'll get there too. Thanks for watching, and feel free to reach out if you want to learn more.
Thanks a lot, Ambra, for sharing your knowledge. Very much appreciated.